viewers and investors. Welcome to another episode of our exciting and informative webinar designed to make your investing journey a little less puzzling. This episode is spearheaded by ICICI Prudential Mutual Fund. I am Kundan Kishore, Deputy Editor, Outlook Money, your host for this session. And today we have an exciting topic to discuss: active versus passive investing. Which one suits more? In recent past, the active versus passive investment debate has taken the center stage among investors, possibly due to availability of numerous innovative products in passive space. Today, we try to decode up with our experts which one suits more, active versus passive investing approach. To guide us through this insightful journey today, we are privileged to have Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential Mutual Fund, and Mr. Arun Kumar, Head of Research at Funds India, one of India's largest digital wealth management platform. So without further ado, let us unravel the world of active versus passive investing with our two great experts. So Chintan sir, first of all, I would like to ask you, could you please help our viewers to understand the key difference between active and passive investing approach?
So it is amazing, Kundanji, that the last 1 week, I have done 2 client events in 2 different cities, and I have done one webinar which was dedicated to active versus passive. So this is my second discussion on it in the last 1 week. And in both the client events, in fact, it's general that in all client events these days, this active versus passive, should I invest in index fund? That discussion is happening, and clients are asking that, which is essentially also telling us that the awareness level of clients, thanks to platforms like you, which are teaching clients about every aspect of financial investing, is quite good. Now, coming to your question on active versus passive and the debate around it. Clearly in India, the first debate should be equity versus something else. So first debate should be that invest in equity. Why should one invest in equity? Now, I think we've probably passed that hurdle with more than 8 crore demat accounts, 4 crore investors in mutual funds. That probably is now accepted, and it will grow as a field. So that's good. Now, after we've accepted that equity is important in our portfolio, the next question comes: should it be in actively managed mutual funds or passively managed mutual funds? And first, what is active and what is passive? Active is basically where, based on the scheme's defined objective, the fund manager chooses the stocks, chooses the weightages, chooses the sectors, and creates a portfolio. That's active fund management. Passive fund management is essentially where the indices are already known, they are publicly available documents, the methodology is well available, and based on the methodology, whatever is the portfolio, the asset management company replicates the portfolio to the extent possible, and that is called as passively managed funds, where there is no active involvement of any fund manager in picking and choosing the sectors, stocks, and weights. That's passive management. Now, to your question, what should be the investor doing if there is an active option and a passive option? I think as we move along, and we'll discuss more, but an investor should have everything possible in their portfolio depending on the size of the portfolio. So if an investor is let's say a first-time investor, they'll probably start with an asset allocation product like the Balance Advantage Fund. And as they grow in their journey, they'll probably have some element of flexi cap, value, special situations. And then the understanding of equity markets being good, they can pick and choose the passive funds. Now, if, for example, an investor in 2020 March felt that, okay, I'm very positive on the markets and I want to buy small caps. I want to buy all the small caps available in one go. Why not just go for the passively available small cap 250 index? Because it's giving me everything in one go, rather than going for specific selection of fund manager, and where the fund manager will select 30, 40 stocks and create a portfolio. I want to buy the entire market. So that's where the passive will come in. So the discussion is not active or passive. The discussion is how we can have the best of both worlds by choosing active and passive, because there are certain segments which are not available in passive. For example, asset allocation schemes and balanced advantage fund category is not available in passive right now. Arbitrage is not available in passive right now. So effectively, you have best of both worlds. And just to simplify it, an investor need not get worried, because this is also one question which comes in, that there are so many funds, so many mutual funds. Active versus passive is only complicating my life. How do I handle it? So we'll obviously, and Arunji is here and he is a master at making things simple, but don't to be too complicated in life. Active and passive both deserve a mention in your portfolio, and how and what we'll discuss as we move along. Thank you.
Arun, what is your take on this?
Yeah, so if you mostly look at this debate of active versus passive, I completely agree with Chintan that the real problem is getting into equity and then hold on for the next 7 years. The real challenge is people invest in equities, but still, the three challenges. One, like there are bad news and then you panic sell out of it. And every time you get new money, there is again bad news. And then you say, I will postpone my investments, and then you keep rotating out of funds based on whichever is doing well at the current times. So I think broadly, behaviorally, equity as an asset class is a behaviorally challenging asset class, and so implementation is the key problem. So let's assume that we have to solve that at the first level. Then people come on to the second problem of active versus passive. My sense is broadly, at least, this is predominantly coming from the global context, and the equation is kind of nullifying into one single element, which is cost. Okay, so that passive is very cheap and active is slightly more expensive, and hence anything that is lower the cost, the better is how the whole equation goes. But if you really think about it, and for a second, this holds true, assuming that everything else is the same. But just to ensure that we all understand it better, for a second, let's assume that costs were the same. Argument sake, let's say all active funds had the same cost and all passive funds had the same cost. There was no difference. Then how would you choose? Now this makes it interesting, because then you suddenly ask saying that, okay, costs are the same, so I will have to pick which is the portfolio that is better for me, right? And now the question is, which portfolio is better? Now, when you say passive, you don't talk about what is that portfolio. Right? Passive, in other words, basically says that the larger the stock, the better. Right? While you call it passive, essentially, let's say if you're buying Nifty 50, you're buying the top 50 companies, and it's again a very concentrated index. So the largest 15 stocks will technically be around, say, close to 70% of your portfolio. So in other words, you are essentially saying a stock at, say, a market cap of, say, 2 lakh crores is more, will provide me better returns than a stock at, say, 50,000 crores. Now, if I tell this to anybody, suddenly the next question that you would ask is, why should that be? Why can't a 50,000 crore market cap company be better? But that's the rule. The rule of passive basically says the larger, the better. So if a company is larger, then I will put more of your money there. So it's a simple rule-based strategy. Now you can't ask, so the question that you have to ask is this the only rule that can work? So when will this rule work? Obviously simple, that if the top 15 companies or the larger stocks do better, then obviously passive funds will have a very, very good streak. So if the larger the larger stocks do well, and if you look at US, the larger stocks have done disproportionately well in the last 10 years, and no wonder passive has done well. Now let's look at other forms of passive where it's called factor invest, where people said, hey, why should this be the only rule? The larger, the better. There can also be rules like higher the quality of the stocks, I should give higher weightage. So this is called quality investing. Then some people might say, I want to go for lower valued stocks. So then you say, lower the valuation, I will give higher weightage. So this becomes a form of value asset type. Then there will be growth. Like if stocks are expected to grow higher or better than the others, I will give a higher weightage. Then there's the other thing exactly opposite to passive, which is mid and small cap investing, which basically says the opposite, that the smaller the companies, it can outperform my passive benchmark. So these are the four broad styles, and obviously there is momentum, which says stocks which have run up well will continue to do well, and then there's a dividend format of investing. So passive is broadly a rough shortcut of explaining the fact that larger the better, but there are also other rules like lower the value the better, higher the quality the better, higher the momentum the better, lower the size the better, higher the growth the better. So the first level is within these five, what will do well will predominantly depend on the environment. But globally, it's also been seen that the other formats of picking stocks have also done well over long periods of time. Now, then you can ask the question saying, within this format, should I go completely rule-based, or can Indian fund managers add some points, and there will always be some few lower quality companies which can get into these indices? Can they pull that off and then add their ones and then add value? So this is the whole equation. So in our sense, we believe that in the large cap space, it's becoming very, very difficult for active fund managers because two reasons. one, the overlap is very high. It's almost 60% of the portfolios are the same. So with 40% to outperform has become very difficult. So if this equation changes, then maybe there might be more, it might become a little more easier. And then the second aspect of the fact is that, again, the cost is also reasonably high vis-a-vis passive. So if the costs come down and the overlap starts to come down, then there is a better chance for large cap. But right now, our sense is large cap is a segment where more or less both are equally placed. But however, in the small cap, you are seeing that active funds comfortably outperform the passive indexes over long run, and mid caps also you are seeing the same trend. So somebody who's mixing large and mid and small cap can reasonably still attempt a decent outperformance over the long run. But again, you have to remember that all active funds compulsorily will have periods of underperformance for sure, and you will have to go through that. So this is how I look at the debate right now. And passive should probably be, as Chintan told, a good starter product. And then eventually, once you get a little sense of how this works, then I think you can step up to mixing different styles and using active preferably. And worst case, you don't want to do that, you can still go for factor-based investing. So this is how I would kind of look at the situation right now.
Okay, fine. Very well explained. But Arun, I'll come to this outperformance, underperformance little later. But I just wanted to understand from you, as you rightly mentioned, the cost factor. Cost is one of the major factor, and that is advantage with the passive funds. So here I would like to ask you, how do these differences impact long-term investments result in case of passive investments?
See, again, as I told, in large cap segment, the cost is a very, very big factor because primarily the universe available is only 100 stocks. So if you look at most active large cap funds, because the universe available is only 100, they have to compulsorily invest 80% of their portfolios into these 100 stocks. And hence the overlaps is very, very high. So on an average, if you look at it, most funds have an overlap of almost close to 60%. So which means you have only 40% of your portfolio, which is differentiated from the passive, say Nifty 50 or Nifty 100. So with 40%, if I have to deliver 2.5% outperformance on that 40% basket just to compensate for 1% expense difference. So let's assume your passive fund is cheaper by 1%. Then on my 40% basket, I have to outperform 2.5% every year just to stay at the same level. And let's say if it's a higher expense differential, then it becomes even tougher. So which is why on the active large cap side, the cost is becoming a very big problem. And the fact that the funds are also overlapping is becoming a problem. So if the overlap comes down and the cost differential comes down, I think then it becomes, then you can, it might again tilt towards the active passive, but that's the problem that we are seeing there. But at least in other categories, though there is a cost differential, there is enough opportunity for fund managers to identify and provide outperformance. So this is why you are seeing small caps, most funds are able to comfortably outperform. Again, you are seeing it similar trends in mid caps. Again, flexi caps are nothing but a mix of large, mid and small caps. So based on the fund managers' skill set, they're able to blend it and they are also able to outperform. So I think except for large caps, the cost part is not becoming a big deterrent as of now. Probably 5 years down the line, we may have to monitor how it affects the mid cap space. But right now, cost is becoming an issue only on the large cap space. The other spaces, they're comfortably able to outperform despite the cost differential.
Chintan sir, I would like to understand from you, typically investments are for long term. And if we look at the performance of schemes across the categories, I'm not talking about large cap, mid cap or small cap. If you look at the performance of schemes across categories, so over the period of time, say 10 years or 15 years, most of the actively managed funds have done quite well. Okay, so in that case, what would be your suggestion for investors, how they should choose between active and passive?
So the first thing is, if investors actually stay invested for 15 years, whether it is active or passive, they'll be happy is what we probably can gauge based on what has happened in the past. Because over a 15-year period, the ups and downs and the risks and negative news, market cycle all plays out. So if investors indeed, and that's how equity should be looked at, that the longer you invest, the better it is. Whether it is through active, whether it is through passive, probably matters less. In the case of India, you mentioned about a 15-year journey. That's probably from say 2003, 4, 5 to today, which essentially is a 17, 18-year journey. India started to basically, the emerging market started to climb after 2002, 3, and there were lots of opportunities which fund managers could probably explore. And that was the phase between 2003 and 2008, where active fund managers did very well. Then, because of the housing financial crisis that happened or the global financial crisis which happened in US, there was a sharp correction in India. And in that phase between 2008 and 2011, passive funds did better than active, because active fund managers took the hit of many of the sectors which were probably doing well in 2008, let's say real estate, metals, etc. However, there were certain fund managers who stayed away from these sectors and were in probably the defensive sectors of pharma, technology, and FMCG, and they did very well in 2009, 10, and 11 also. So while generally fund managers struggled, there were some who actually ended up doing well, especially those who follow the value theme. 2011-12, India was going through a bad time. And 2013 onwards, if you look at it, market started to bounce back. The period between August 2013 and 2018 January, again, active fund managers did very well. So it's a toggle between active fund managers doing well in 2003 to 2008, 2008 to 2013 being a very difficult period for India in an economic sense, and markets not doing well, meant that the larger caps did well, and so the passive funds, which generally are investors tend to invest in, let's say the larger cap funds in passive, that did well. 2013 to 18, again, we saw where active did phenomenally well across the board. I think generally, and Arun would have the numbers at the back of his hand knowing him, that 2013 to 2018, active funds did well. Again, 2018, after the implementation of long-term capital gains tax, there was a very sharp fall in the side markets, mid caps, small caps. And 2018 to 2020 till COVID struck, passive did very well, because the entire contribution of positivity to the markets was in the top 10 names in Nifty. Apart from top 10 names in Nifty, every other category and segment below the top 10 was almost negative, and sharply negative in the case of mid and small cap. So in that scenario, where the fund manager is diversifying, they basically took hit between 2018 and 2020, and passive did better than active. And the story for the last 2 years, between 2021 and 2023, is pretty much in favor of active funds, where active funds have been able to beat benchmark, even in the large cap category, because of the turn in the markets towards a more broad-based rally. So the answer is very simple. I do not know what will happen tomorrow, but what I know is that it is let's say, it depends on the market cycle, whether active does better than passive. What investors should ideally do is have an asset allocation, have an advisor in place. The advisor can basically advise the investor between active and passive. And within passive, just to highlight, there is a concept of gold fund of fund, silver fund of fund, which is unique, right? And that can be added to your portfolio to give you that necessary diversification. So passive, of course, has a lot of options. And as Arun mentioned, in passive, you can choose. If you are a momentum investor, you will get that factor based fund as well. If you want low volatility and more stable stocks, you'll have that factor. So the options are there, but I don't expect every investor to know every possible fund that is there. I do this for a living day in and day out, and I cannot keep a track of all the funds that are available in the market, honestly. So it requires probably some amount of focused advice, and that can be provided by a good intermediary to each investor. So self-select is good, but if you have an advisor, you'll get a holistic approach, which is very important to get both active and passive, or the best of both active and passive. Thank you.
Arun, I would like to understand from you, as Chintan rightly mentioned that certain active funds have given better returns, or they have performed well in certain market times. So I would like to understand from you, because you are hardcore into the research. So basically, as far as active funds are concerned, in addition to generating alpha, containing the downside is equally important for actively managed funds. So what is your experience so far? How the fund managers have managed contained their downside when there was an unfavorable market scenario?
See, at least the Indian evidence is overwhelmingly in favor of active fund managers when it comes to reducing the downsides. So if you take the recent COVID fall, especially for a small cap, is probably a good category, which is probably the most volatile, and that is a good category where you can see if active fund manager are adding a lot of value. The index was almost, let's say, the fall started from 2018 and it went on till 19, and then it started to recover. But then again, 2020 COVID hit. So let's say you measured from 2018 start to the bottommost point at 2020, say around that March 23rd level. The index was almost down close to 60%, almost 58 to be precise. So let's assume it's 60%. But most of the funds were anywhere between 40-45%. So while it looks only like a 10-15%, but if you look at the amount of returns required to get back to 100, it becomes a massive, almost like a 50% differential. So it's a huge outperformance that small cap funds have done. The same phenomena has happened in mid caps as well. So broadly, if you look at how small and mid caps work, they do extremely well vis-a-vis the mid and small cap index, especially during falls. And which is why over a long period of time, every time there's a sharp fall, the active fund managers tend to do extremely well. And then obviously in the next 1 year period, it will look like active fund manager underperforming because you have fallen lesser and you require much a lower amount to get back, while because your index is fallen a far higher amount, it looks optically that this is doing very well. So which is why once you measure over long cycles, which contains a large upcycle and a down cycle, and then you again wait for the next upcycle, you will find that active small caps and active mid caps and also active flexi caps, because again they're just a combo of large, mid, and flexi. All three have been comfortably, and in fact, large caps also, if you look at extended time frames of over 15 years, because they have the edges are a little small, so they will have to, you will have to give them a long enough rope. You can't keep checking for every 3 year, 5 year, but at least on the small caps and mid caps and flexi caps, a 7-year time frame is good enough for you to meaningfully see a decent, provided that you pick the right fund managers. And again, for large caps, my sense is you might have to give them an extended time frame because it is getting a little more difficult vis-a-vis the other segment. But it's clearly in favor of active funds. The data is clearly in favor of active funds when it comes to reducing the downside compared to the benchmark, at least from an Indian context.
But here, Arun, it's very difficult for common investors to pick the winning horse. I mean,
right.
Fund that will do the better in the future. So in that case, I mean, passive works well.
Right. So if you are somebody who is who doesn't have any intermediary or an advisor to guide you, then I think it is, let me be honest, it is a little difficult because the first challenge is how do you figure out who is the right active fund manager for you. And then again, as Chintan told, there are different styles, right? There are styles like low volatility, momentum, value, quality, and all these styles end up doing well in certain phases and they also underperform in certain. But the way it works is when they outperform, they more than compensate for the underperform. So an ideal good advisor would kind of blend different approaches together and figure out some good fund managers who have been there, done that over long periods of time, and who can go through those tough times without giving up. If you look at a classic case like iPro's discovery, iPro value discovery, till 2020, if you look at their 5-year, 3-year, 7-year performance, nobody would have touched it. But now suddenly in the last 3 years, the fund has done extremely well because value was out of favor. So not just iPro value, any other fund manager who had chosen that value oriented style was going through a bad time. So it's not the fund manager's fault. It's just that the style wasn't in favor. Now quality is going through bad times. But again, after 5 years, you will again see that quality also comes back. So the idea is different styles do well at different points in time. So if you are if you want to do a good job in active fund investing, you shouldn't only go by past performance. Then you will end up only overloading on a particular style, only to see that the style is underperformed after you entered. So you need to consciously blend 4 or 5 styles together and possibly some global exposure and figure out the best fund manager. It is a little complicated, so you may need some help on that. But let's say if you don't want to do that and if you're a DIY, I think you should start with a simple broad-based passive index. And then as you gain expertise, you then figure out whether you want to do factors or whether you want to do fund. But if you are finding it difficult, stick to a simple asset allocation plan or products which are ready-made, which can do the asset allocation also, and then start your journey. But this, I think you need, definitely you will need some help on figuring out which fund manager and how to blend these different styles together.
Arun, I will come to you for the portfolio part, but let me understand from Chintan sir, what all options are there in passive space. Then we'll make portfolio together. So Chintan sir, could you please help us understand what kind of products are there in passive space?
Passive funds include index funds and ETFs both. Just to highlight again, because many people would get confused, there is not much difference between an index fund and an ETF. An index fund and ETF, both are mutual funds. The difference is index funds is mimicking the benchmark, but it is like a typical mutual fund wherein you put a subscription and redemption, and that happens, based on the NAV. In the case of ETF, ETFs are also mimicking a benchmark, replicating a benchmark, just that particular portfolio is listed on the exchange and you can buy it and sell it in units as low as 1 unit. So ETF is nothing but basically a replication of portfolio which is listed, and index funds are not listed. They are basically available for purchase and sale based on the day and NAV. Both are passive, both have indexes or underlying indices which are well defined, and the methodology is also well defined. Now, coming back to the options that you have. Now, if you look at the options and passive which you have, the first option is market cap based indices, which is what Arun Bhai was mentioning, that the most popular, the largest AUM typically is in market cap weighted indices. Typically the Nifty 50, Sensex 30 are two broad benchmarks which have probably in the industry the largest AUM today. And they have the top 50 names and top 30 names in India based on the methodology of the respective index provider. So those are large cap indices. Then there are mid cap indices which follow from 101 to 250 by market cap. Then there are small cap indices which are beyond 251, have 250 stocks. So these are market capitalization based indices whose weights are also decided by the market cap or the free float market cap. Apart from market capitalization based indices in India, as the demand for products and as the interest of AMCs have also increased along with the interest of distribution and investors, you have a lot of sectors and themes which are available in passive, right? So much like how in active funds you have an infrastructure fund, an FMCG fund, a pharma fund, similarly on the passive side also you have a lot of options of themes. If I have to speak about iPro and the various themes which are available, you have banking, private bank, you have financial services, ex-bank, you have healthcare, you have IT, you have auto, and the list is quite wide. So we are trying to basically give an option to the investor that if you are positive on any particular sector or theme, you should have an alternative on the passive side to invest in that theme, be it for a trade, be it for a long-term allocation that is dependent on the asset allocation of the investor. So market cap based indices, sector or thematic based indices, including infrastructure as a passive fund is also available. Consumption as a passive fund is available. If I move to smart beta ETFs, which is essentially what Arun Bhai was mentioning, momentum, low vol, etc. Smart beta is, while it sounds technical, in very simple terms, smart beta ETFs are ETFs which have underlying indices which pick and choose stocks on the basis of certain factor or factors. For example, low volatility as a factor. So you define the universe. Out of top 100 companies, I will pick the stocks which on the last 1 year basis has shown the lowest volatility. So you basically rank the stocks on volatility, the lowest 30 stocks on the basis of 1 year, you pick those stocks. And in the case of low vol, even the weightages are then basically based on the lowest volatile stock getting the highest weight. So it is relatively lowest volatile stock getting the highest weight, and that's how the weights are taken care of. So that's on low vol. Momentum is slightly different from low vol, wherein the best performing stocks on the price basis on 6 months and 1 year are taken into account, maybe from a universe of say 200 stocks, and that 30 stocks which have shown price momentum, which are the best performing on 6 month and 12 month adjusted for some standard deviation, those are picked up and then rebalanced every 6 months or based on the methodology. So you have smart beta ETFs. This is very similar to what active fund managers actually do, just that active fund managers would probably have the flexibility of being value today, growth tomorrow, quality later, depending on the market cycle. Very difficult to do, because as an individual, if I'm a value fund manager, for me to become growth fund manager is very difficult, or a very high quality at high price is very difficult. But theoretically, you can do that in an active fund. You can maneuver yourself. But in a passive fund, which are smart beta oriented, the fund is defined. So it's low vol, momentum, quality, value, which is NV20 popularly known as. So those are anyways defined. So you have market cap, you have sector thematic, you have smart beta, and then of course you have commodities. So in India right now, gold and silver are the two commodities which are available. There are some which may be having passively managed international funds also, like NASDAQ, for example, is one of the passively managed international funds, which is a NASDAQ index fund. And the last piece is on the debt side. So I think the PSU SDL as a category had grown significantly and still is relevant for investors. So you have that category also available on the passive side. So these are the broad categories which are available. And over the last 5-6 years at ICICI, we've basically had this clear determination that we should provide everything which is possible from an investor centricity perspective, which will allow them to create the portfolio. And then now I'll hand it over to you and Arun to basically create that portfolio with the products that we've basically launched over the last 5-6 years. Thank you.
Thank you, sir. So Arun, as Chintan has rightly mentioned that there are plethora of products in passive space also, and you were talking about this growth style funds, flexi style funds, value style funds. So in that scenario, a common investor, how an investor can build their portfolio?
So you can look at it in two ways. One is somebody who is completely new and does not have any guidance.
So let's make distinction between new investor and existing investor.
Sure.
So let's discuss first the new investors.
Right. So somebody coming first time to the equity markets, complete new investor. Obviously, the first step would be to decide how much goes into equity, how much goes into debt. So let's say they've decided on that. Now the question is, let's say I'm say 70% equity. Now the question is, how do I build my 70% equity? Now I might have an SIP which goes, mostly it will be an SIP because I will keep getting my salary, and there might be occasional lump sum. So for a starter portfolio, the simplest index, which is the market cap weighted index, can be a very broad based index like say the Nifty 500 or the BSE 500. Or let's say if you want to even more simplify it, just stick to a Nifty 50 fund just for starting. Then maybe do it for 2-3 years, because the real challenge is to adapt for the equity market volatility. Because every year you'll have a 10-20% fall, and whenever you have the incremental money to invest, you will find it very difficult to invest, and then you will always see something else doing well and you'll be tempted. So first 2-3 years is a good time for you to because anyway it will be a small amount and you are also building it. So the first level is to just get comfortable with how this asset class works. Now once you're done, say 2-3 years, then probably you can add the second level of slightly a higher volatile but better return kind of a product, which is a simple Nifty mid cap 150 index. So first level you start with say the Nifty 50 or Nifty 100. And then you add the next 150 companies which are classified as mid cap, probably 30% of your portfolio. So roughly it becomes 70% into large cap, and then the 30% goes into mid cap. Then maybe again you let it run for 2 years. So by 5 years, you have probably seen different parts of how the market behaves, and you also have got a good sense of how mid caps behave and how large caps behave. And post this, now you can take a call. Now whether you want to move into these active based products or factor based products, but broadly the way we approach the active side is that we call it the 5-finger strategy, where the simple idea is there are different approaches which work over long periods of time, apart from the simple market cap weighting, which is as Chintan told, there is a quality is one particular approach.
Right.
There is value, which is another approach, and then there is growth at reasonable price, which is another approach. Then there is mid cap or small cap investing, which is another approach, and then there is global investing. So we pick 1 or 2 good fund managers to play all of these and put together as 20% each into so 5 funds, 20% each. We club them together, and we've been running it for the last 4 years. We've not changed any funds, and it's delivered an outperformance of almost close to 4% with much lower volatility. So the point is, but the key point to note is that every 1 year you will find that completely new set of two funds underperform. And when it underperforms, it's drastically underperforming. And there are two funds which are doing dramatically well. But that's how the solution is supposed to work. If all five work really well at one single point in time, then you have to be worried, because that's not the design. The design is 3 has to do well and 2 has to do bad every year. And which is the 3, which is the 2, will have to rotate, will have to keep rotating once every 2-3 years. So this is one approach that you can use. So broadly, this is how I would look at it. And for somebody confused, you should probably start with both. And then once you get conviction that whichever works well for you, then you start moving either to active or passive. So we have seen a lot of our large clients use this blended approach, and then based on the comfort, kind of keep moving towards, I mean, for our case, it's active. Since active has worked for them, they've slightly moved towards active. But this is also one more approach which very large investors can do, because at large sums of money, you are also in a dilemma, and you don't start and you keep debating this. So I think 50-50 is probably a good starting point for somebody who's very confused on how to start.
So basically, you mean to say that a new investor should begin with, passive funds.
Yeah, if you're a new investor and if you don't have any guidance, then passive is a good way to start, and over a period of time move to active. But if you have the required guidance, you can start with active, but make sure you are blending different styles. Don't go only by past performance, because mostly, let's say if you're investing today, mostly you'll end up with only value funds. You won't have any other, you won't be touching anything on quality. Today, maybe it won't be even value, it'll probably be only small cap funds, because small caps have done extremely well. So if you only go by returns, then you will end up over exposing yourself only to one particular approach. And when that cycle turns and that approach doesn't do well, then you again shift to the other approach which did well. So every time you will miss out on the past 3 years, because you have to remember that if you're entering value discovery today, you have to ask, why didn't I enter 3 years back? Because if you go back 3 years, then the fund was underperformed. So similarly, if you have quality in your portfolio, you should ask, why did I enter quality 3 years back? Because quality was doing extremely well as a style. But if you had both of these together, though quality is not doing well, you will have the behavioral edge to sustain, because value is more or less compensating for quality's underperform. And because the whole point is how the market environment changes is very, very difficult to predict, because there are hundreds of events which happen. So nobody knows, including the fund manager, as to when the environment will come in favor. Because if somebody could figure that out, then you will have a product which will only get the best style, and you'll have one AMC which takes everything out, right? So the fact that nobody has been able to do across the world means that you can't time when a style comes in favor and out of favor. So the best thing is to blend. For experienced investors, you look at active, blend different approaches. For new investors, start with passive, and over time move to active based on your knowledge level. If you're new and you know how this works, then you can start with active. So this is how broadly I would look at the whole in terms of how to build portfolio.
Chintan sir, would you like to add something here?
Arun has covered it well, but generally when I do client events, this question comes, right? Where should I put my money? I said that where should I put my money has probably 10 different questions which will come to mind. What is your current income? What is your current allocation? What is your responsibility? Do you have a marriage and family, child going abroad? You want to buy a car? You have an EMI going for your home loan? So all these questions will come in. So instead of asking 10 questions to clients when they ask me where to invest, I essentially tell them that it's very easy for you to create a portfolio of funds which will suit you over a long period of time for wealth creation. We've been proponents of hybrids in a very big way. So much like I said, you need to have active and passive both. I'll probably create something which I believe will work for most investors. And then if Arun wants to add something, Arun Bhai can add. One is, you need to anchor your portfolio. You need to build a strong foundation for your portfolio. That is generally built with funds like Balance Advantage Fund category or multi-asset category. Clearly there you get fund management taking care of your equity and debt valuation based investments. And I think from an active fund management piece, we do believe you should have about 40 to 50% of your portfolio in Balance Advantage Fund and multi-asset fund as a combination. Then there are many options that you have: special situations, value discovery, flexi cap funds, multi cap funds, small cap, mid cap. Depending on your risk appetite, you can have 2 or 3 of these and have 30% of your portfolio in that. Balance 20% of your portfolio, I'd say you can have simply in 10% of that in gold ETF fund of fund or silver ETF fund of fund, as the case may be. Because I believe with 13 years of underperformance for both gold and silver, specifically gold, in an uncertain economic environment, that will help you hedge your portfolio well. And also you can look at any of these smart beta products in your portfolio. So low vol or quality momentum, depending on what you've chosen and your active fund, if you want to complement it, you have the options in the passive fund. And if you really don't know what to do, then you have the option of buying a single instrument which will give you exposure to 500 stocks in the market. So you have large, mid, and small. You have the top 500 names, which is essentially either the NSE 500 or the BSE 500, as the case may be. We have the BSE 500 ETF or the fund, which is basically on the BSE 500 index. So you don't have to worry. You basically get the 500 stocks and then you keep it for the longest term. And that should help you participate in a meaningful manner in those stocks and grow your wealth. So you create a portfolio or a bouquet. I have not spoken about international investing right now in general because international markets look more vulnerable, but that could also be a piece at some point of time later because you have some funds which give you international exposure. But currently it's probably India which is looking better along with commodities. Thank you.
In fact, Arun, I would like to ask you, your opinion for our young investors, those who are quite new and they simply look for which fund has given 5 years or 3 years, not 5 years. They typically look at 2 years, 3 years. Some of them might look at 1 year return and they blindly invest in those funds. So what would be your advice for such kind of investors?
See, the first thing is to realize that any fund, be it passive or any factor fund or sector or whichever fund or active fund, all funds will compulsorily go through a bad phase. Like, let's say if you are passively invested in Nifty Next 50, let's say 3 years back, everybody used to say, hey, this is one index which always does well. It's been able to beat Nifty 50. It's been able to beat most of the active funds. Now suddenly, like you see that that has done extremely bad compared to Nifty 50. So suddenly now everybody is like, probably Nifty 50 should have. So the whole point is that at all points in time, irrespective of whichever fund you buy, you will always have something better than your fund. Especially after you buy in the next 3 years, you will. That is the nature of things. So the first thing you have to be really clear in terms of why are you buying the fund. And the next question that you have to answer is, if let's say I'm buying an active fund, for sure it will have a 3-year or a 5-year stretch of underperformance at some point in the next 10 years. Now, if you are not able to stick to it at that point in time, most likely you will give it. So which means that you need to know one, which is the fund. So the toughest part is behaviorally, how do you stick to something which is not doing well? But that's how it works. So which is why I think you need to know what is the approach that the fund manager is following and try to blend it with something which is probably the opposite or something which is very complementary, so that not all the 4 or 5 funds are going through the entire downturn together, right? So which is why my sense is behaviorally active funds' biggest challenge is that these underperformance phases, people give up and then they move to some other style which is currently already done well, only to see the fund performance again go down. Then again they move on to the fund from which they exited. Then by the time they do it over a 10-year cycle, they end up drastically underperforming passive. Now the way passive investors have mentally solved for this is that every time they see any other active fund outperforming, they tell themselves that either way I couldn't have identified it earlier, and hence this is the right strategy. So you have a mental language that you have given to you, which helps you to be convinced that though something else is doing well, either way I couldn't have picked it up. So because that language is there, it becomes a little more easier for passive investors. But for active investors, which is why the approach of blending it together will give you the feeling that, hey, there are other 2 or 3 funds which are doing well. These two were doing great 2 years back. Now it's okay because eventually in the next 2-3 years, this will again come back. So my sense is try to blend it together, because if you only go by past performance, you'll have a very, very bad experience. Go by styles, go by good fund managers. If it's on the passive, make sure, as Chintan told, get the entire 500 as a starting point. Then eventually add more complexities to it. But passive also requires a lot of active decisions. It's again, as Chintan told, there's a gamut of ways in which you can play the passive as well. So first level, keep it really simple. And as much as possible, once you get to a larger size, do get some proper guidance. Whatever the extra amount that you pay, more or less gets compensated in the long run, because any small mistake kind of compounds over the long run. So at a larger sum of money, it's far better that you get a decent and a proper guidance.
So I would like to conclude here that if you are new to investments, begin your investments with passive funds, and later on you can add active and other style of funds in your portfolio, right?
Sure, that would be precisely my point.
Okay. So with this note, we have come to the end of today's episode. Thank you, gentlemen, for joining us today.
Thank you, Kundanji. It's always a
Thank you.
pleasure.
Thanks a lot. Thank you.
Viewers, we hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at editor@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your personal finance magazine. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.